trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Of our Market Rebels, it's that time again, Stu.
It is that time again. This is some week, Bill.
Oh man, it's a pretty harrowing day there, and probably more to come. But that leads us into a good discussion on managing risk, which is really what options are all about. And a question that we've been getting a lot lately.
Wait a minute. I thought options are supposed to just be there to make you money.
That's what a lot of people have you believe, that they're speculation tools, that they're there for a lottery ticket. I've heard people say, oh, those were just created for the rich to gamble on the market. You're going, really? Crazy ideas, but they are hedging tools.
Yeah, they are hedging tools. That's how
you can certainly use them to speculate because they are so powerful. But once you learn how to manage risk, it's going to help you survive days like that, and also how to profit coming out of them.
And what do we have to do to manage risk? We have to identify what the risk is that we're trying to manage, right?
Absolutely. And so one of the most versatile tools in the toolkit here is the vertical spread. And we've been getting a lot of questions about this lately in our Q&As. And so we thought this might be a good way to help people understand kind of a funny way, but yet a very intuitive and helpful way of understanding the different philosophies between the debit and credit spreads.
This isn't the chicken thing, is it, Bill?
I know. I knew you knew where I was going to go with this. It's exactly what it is.
Okay.
All right, so here we go. Let's start off with our Chalk Talk question. This is our little intriguing question that we will answer at the end of the session. But is a debit spread reducing risk or cost? Or maybe both? What do y'all think? What's the primary reason that traders would use a debit spread? And of course, we could ask the corollary, what's the primary reason for using a credit spread? Are you reducing risk or cost? What's going on there? All right, so think about that for a moment. Hopefully we'll get it answered during the presentation, but we'll definitely come back at the end and answer it. So our topic today, you guessed it, Stu, cheaper chicken. I love this. It's just a kind of a humorous way of understanding the different philosophies between debit and credit spreads. Now, we know that most people, what's the one that everybody likes out there?
Credit spread.
Of course, because they say I'm getting paid for it.
Why
would I do it? Right. Why would I do a debit spread when I can get paid for it?
Why would I pay for something when I can get paid?
When I can get paid. But what they don't realize is the debit spread is an asset. It can increase in value, and the credit spread is only a liability. It can never, ever make you money by itself. The only reason you make money is from that initial credit. But other than that, it's a liability. So you're not getting paid for an asset.
And here's a clue, people. The liability that you have may actually outdo the credit that you received.
Oh, it absolutely right. Nobody's going to pay you a credit bigger than that. That would be an arbitrage. That would be a great credit spread right there. I'll pay you $6 for that $5 spread. Deal.
Yeah, there you go. Right. This concept of like, it's just, I'm going to sell dollars and, spend them is,
You're just opening the doors for liabilities. And so when you get the really harrowing days like we had, um,
earlier.
you don't
Yeah.
want to be holding liabilities. So let's find out a little bit more about these different philosophies for vertical spreads. Cheaper chicken, what's this all about? Well, what it is, again, it's just kind of a somewhat comical way or a humorous way of understanding these philosophies behind a vertical spread. And it shows why it's either a debit spread or a credit spread. So again, that's really it's a way to help you understand that, especially for people who might be new to options and for sure vertical spreads. So before we get started with the in-depth look at cheaper chicken, please check us out, marketrebellion.com/get started. Lots of great articles, tutorials, videos just like this, all for free to help you get a good foundation before you start trying to manage risk. So to understand this, we're going to start off with a little bit of a pricing principle. We talk about these a lot in Q&As and in some of our classes. I'm a big believer in understanding the fundamentals of what makes an option tick. And if you understand certain boundary spaces or pricing barriers, boundaries, they really help you to understand strategies. So like I'm sure some people are wondering, why couldn't you get paid $6 for a $5 spread? Right now, you and I know because it's a violation of the boundary. But a lot of times people don't. So that's why we teach pricing principles. So one that will help you here, there's lots of these, by the way, but the one we're going to cover today just is that lower strike calls must be more valuable, meaning than higher strike calls, and higher strike puts must be more valuable than lower strikes. Now, this is assuming obviously the same stock, but the same expiration. So for example, if we have the $100 call versus the 105 call. Now we've got the same expiration, same stock. So Stu, which one of those is going to cost more money?
Well, 100. So,
See, how would Stu know that? I'm
so
sure some people who are new are going, why would, where's the stock? How many days are there to expiration? Where? And it doesn't matter.
Yeah. What's the interest rate? So look, this is what Bill and I do in our sessions and our coaching classes. He says lower strike calls must be more valuable, higher strike puts must be more valuable. So your job as the learner is to say why.
Say why.
All right. And then when you start having the ability to just put 2 and 2 together and come up with 4, then you're understanding what Bill's talking about here, these principles, and you don't have to start thinking about, well, what's the formula and what's the 80% thing,
Right.
what's this and what's that, and when do I sell them and when do I buy? It just intuitively begins to make sense, and all the light bulbs start to go off. And the more light bulbs that start to go off, the better understanding you have, and the more light bulbs continue to go off, and it just becomes this exponential growth in your learning of options theory, and it just makes the job so much easier because now you begin to know what questions to ask, and the answers just start to flow because it just makes sense.
Absolutely. So in this case, as Stu said, the $100 call must be more expensive. Now, what if we look at the $100 put versus the 105 put? And Stu, I'm not going to tell you where the stock is or what the interest rates are or the days to expiration. Which one of those is more expensive?
Wait, what did you say the ticker was, and what day was it?
I'm not going to tell you the ticker.
It's going to be the 105 put, though.
Now, how did Stu know that? And again, a lot of people out there going, wait a minute, couldn't it be possible that you've got a lot more buying pressure on the 100 or selling pressure on the 105 put and it's actually cheaper? The answer is no. It's not. If it did happen, it would be for a nanosecond. Arbitrage would correct it. But we know for a fact the 105 put must be more expensive. So Stu, you mentioned a little bit earlier about you have to understand why.
Yeah.
Let's talk about the intuition behind it. Let's start with the calls. Why must the 100 call or a lower strike call be worth more money than a higher strike?
Is that a question for me?
That's a question for you. How would you answer that?
Because you have the right to buy the asset at a cheaper price.
Cheaper price. Right.
And
if I came to you and said, hey, Stu, I'll sell you the stock. You can either buy it for 100 or 105. What do you all think Stu is going to say? Of course he's going to say 100. For buyers, lower prices are better. Well, the market figures that out. And one of the things that we teach in our class is that anytime you hear the word better, you can be sure it comes with a higher price. That's kind of another way to back into the intuition behind it. The market recognizes that if the 100 call were 5 and the 105 call were 6, something's wrong. And the way that it would get corrected, you would buy the 100 and sell the 105. That would be the arbitrage, and it will eventually flip them. So yes, it's because lower strike calls or lower strikes are better for buyers, the lower prices.
This is like kind of a big picture thing. It's kind of the efficiency of the financial end of it, right? It's the efficiency of the market.
Absolutely.
The markets themselves are driven in such a way where it's not going to allow the opposite to occur here, because it just doesn't make financial sense. Like who would do that? Who's going to pay more for a right to pay higher? I mean, it just doesn't make any sense.
Exactly right. So this is how we know that these relationships must exist. Now that's going to help you, especially for people who are new to spreads, to figure out which is a debit and a credit. It will also help you understand why one is an asset and one is a liability. All right, so this is a really important thing. We like to teach stuff like this. As Stu said, this is where the light bulbs come in, because you're going, just by understanding one principle, suddenly you'll start to realize a lot of things. They really compound. So let's start with a debit spread. So a debit spread, let's say that you buy a $100 call and it's trading for $10 in the open market. Now, a lot of people would say, well, that seems like a lot, maybe not in terms of volatility, but a lot of dollars. For whatever reason, we just don't want to spend 10. But we look and we see that the 105 call is trading for 7. So if we buy the 100 and we sell the 105, that's a net debit. So why is this a debit?
Boo, I want a credit.
Why? Okay, answer. Why first? Why is it a debit, and why wouldn't you get a credit here? Why does this have to be a debit spread?
It has to be a debit because the 100 call that you're buying is
it's a more valuable strike.
It gives you the right to buy the stock at the cheaper price.
Right. So we know it's going to have a higher price tag on it. We don't know it's going to be 10.
No,
but I do know if you buy the 100 105 vertical, it will be a debit.
And you know what? That's a real good point here. Let's just segue just for 10 seconds here. These options on your matrix that you look at, they're all tied in together.
Oh, right? Sure.
It's relative. They're all relative to one another. So if something happens to the 100, it's going to tug on the 105. And those things are going to kind of move in a sync-like pattern that is dynamic, for sure. But they will be affecting one another.
Yeah, they're all tied together. If you pull on one, they're all, not to the same degree, they don't move the same dollar amounts, but they will all move. Right. But here we've got a net debit of 3. And the thing that I want you to understand now is because the 100 is the more valuable strike, another thing to understand, we call that the controlling strike or the controlling option.
Yeah.
That is going to help you to understand even with diagonal spreads. Okay, so if you buy a 3-month $100 call and sell a 1-week 95 call, I can tell you it's got a bearish bias. Why? Because you're selling the controlling strike. And some people say, how'd you figure that out? It's one thing that you had to know. It's which of these options is really driving the bus. The 100. So let your eye recognize that's the controlling option. Now ask yourself, what are you doing with that strike? What are we doing with it here, Stu?
Well, it looks like we're buying it, though.
We're buying it. So now watch how easy it is. You're buying a call. Don't worry about this one down here. That's just a hedge. The sale of the 105 is to reduce the cost of the 100. So what we're doing, we can also see that this is a bullish bias. Why? We are buying the controlling strike. What is it? It's a call. So buying calls is bullish. So that's another way to understand why this has to have a bullish bias to it. And too many times people come in here and they go, oh gosh, this one's the 100, 105. Why is that bullish? I forgot the formula. I'm so confused. I sold the put spread. Why is buying a call spread the same as selling a put spread? This is so confusing. If you understand one thing, it all falls into place. And that's what we want to do, is to make this stuff easy for you.
You could just look at the deltas and see that you're not long.
And you could look at the deltas, right? We don't have them listed here, but sure, that'd be another way to tell. Absolutely. The deltas here are going to be what?
But you wouldn't even have to look at the deltas because you would intuitively know that the 100 has a higher delta than the 105.
Yep. Now here's some other questions. Let's talk, since we're on this topic here, Stu. We didn't say where the stock is. We just know that the 100 call is worth more. How do we know that the stock's not at 115?
Well, depends on the time here, kind of, but because if it was at 115 and we had a relatively short period of time, this spread would be trading it closer.
Well, no. I'm saying look at the 100 calls where I was going with this, not the spread.
Oh, I got you. How do we know it's not 115? Because it would need to have $15 at least.
The call's got to be trading for at least 15.
Intrinsic value. Yeah.
Right. Now what Stu is looking at in terms of the spread, if we didn't have a lot of volatility or a lot of time, that spread would probably be closer to 450, 475, something like that. And here it's trading for 3.
Yeah.
So that's another little clue to understand how they're moving. Could the stock be below 100? Sure. Yep. Could be a lot of time. There could be a lot of volatility or both pushing that up. Could the stock be at 102? Yep, absolutely. 105, sure. So we can't say for sure where it is, but we can tell you where it's not. We know it's not above 110. All right, so those are some things that will help you when you're
And that's
looking
a really important principle. I don't know if that's a principle, but that's a really important thing to kind of know as well, right? This whole concept of intrinsic value, intrinsic and extrinsic. An option has to have, it's got to have intrinsic value. It's going to have intrinsic value if it's in the money, and it's how much. Well, it's real easy, right? It's just the difference between where you have your right, that's your strike, and how much is it? Where's the stock trading?
Right.
You know, look, it's if it's 107 and it's 100, you have the right to pay 100, and it stocks the assets at 107. There's $7 of intrinsic value, and then if it's trading at 10, then there's $3 of extrinsic value.
Right.
Right, and there's a lot to be gleaned from just being able to put that all together.
Oh yeah, just by looking at these. So we could even say the stock's probably not at 112 because that means this would be trading for exactly 7. And then of course this wouldn't be trading for 10.
No, not at all.
We can tell that that's not true. But my point is just by understanding that one simple principle, you get lots and lots of insights. But the thing that we want you to see right now is when I'm looking at this, we're buying the 100, selling the 105. I'm buying the more controlling call. If I'm buying the more valuable asset, bingo, it's a debit. It's a debit spread. I also know it's bullish because we're buying the lower strike. We're buying the controlling option.
Mm-hmm.
So the thing to understand here with this whole cheaper chicken is that a debit spread can be thought of as a cheap strategy. What you're trying to do is to reduce the cost. That's the main goal. Not the only one, but the main one for a lot of traders is, I just don't want to spend 10. Or maybe it's the stock usually trades at 30 volatility and it's at 70 vol. Well, no, you probably don't want to be buying that option by itself. Kind of might be forced to spread it off.
Well, it's you kind of just said the same thing, really. Like if it's trading your 10 and you don't want to pay 10, well, why don't, you got to say to yourself, why don't I want to pay 10? Because the volatility is too high, right? It's 70 and it's usually 35. So maybe the real price really should be 5. So yeah, I don't really want to pay 10 if it really should be 5, but it's not 5, it's 10. Well, why is it 10? Well, because vols are higher and there's something coming down the line and the market's recognizing that. So that's a piece of the risk that you now say to yourself, hey, maybe I'd like to hedge that
Spread that off. Yeah.
And you can do that by initiating a sale on the 105. And now you've hedged off a good piece of that. What we call it here, Bill, like extra implied volatility, sort of, right? Just
but it's certainly, the volatility portion. But the thing is, yes, you might be buying high vol, but you're also selling it.
Yeah.
That will tend to mitigate it. Now we're not even getting into the fact that there might be different skews going on here, which might make it really a good deal to sell. But at a minimum, you're just trying to hedge off maybe that high volatility.
Right, it's going to lower your delta. It's going to lower your gamma. It's going to lower your theta.
Absolutely, always trade-offs.
And do all of that. Yep.
Okay, so let's take a look at it.
Yeah, there you go. I was going to say at a potential opportunity cost.
Yep. So there's our 100, 105. Remember, we always get a bend at our strikes. We get a bend at 105, one at 100. Now, in that example, we had a cost of 3. That's the most we can lose. That's where this graph bottoms out. Doesn't matter if the stock goes to 0. -3 is it.
Let's assuming you don't do something stupid through expiration.
Now, let's look at another principle here. intuitively. We didn't really cover it here, but we can kind of get some insights into it. If I have the right to pay 100, which I do by buying the 100 call, and I have the obligation to sell at 105, which I do by selling the 105 call, how much can I make on that deal?
Well,
If I can buy at 100 and sell at 105.
I think there's $5 in there if I did my math correct.
I think I'm coming up with 5 too.
So
So
that
the
would be
thing is, no matter
12.50.
how high that stock price goes, the most you are ever going to make from this spread, or the most it's ever going to be worth, is $5.
Go back to like option, go back to arithmetic 101. If I pay 100, if I have a right to pay 100, or if I buy it at 100, and if I sell it at 105, what's the difference? $5.
Yep, just think of the stock. I bought it at 100, sold it at 105. So we know for a fact in the open market, the very highest price you will ever see for this spread is 5. What if the stock is at 200? That's $5. Stock is 300. In Philadelphia, it's how much, Stu?
$50.
$5. Great line from Trading Places. So anyway, the point is that if it's worth $5 maximum, but you paid 3, what's left over? C2. Now, a lot of the mystery is being removed by saying I have to memorize this stuff. No, you don't. Just understand your boundaries. The upper boundary here is 5. You paid 3. That leaves you 2 left over. So here's your long call.
Tie this all in together with intrinsic and extrinsic value, and what we know happens with extrinsic value, it goes away over time or distance.
Yep.
Usually both. And what's left? Intrinsic value. Well, how do you have intrinsic value? It has to be in the money. So when it's in the money and all the extrinsic value goes away, bang, bingo, there's your $5, which kind of takes away the question of, well, the stock's trading at 107 and I have 3 weeks to go, and how come it's not trading at 5?
Yeah.
If there's extrinsic value left, and that's acting as it's decreasing the.
It's a braking system, right? It's dampening that value. So here's the law. If you just bought the 100 call, your risk graph would look something like that in red, right? Our hockey stick. And you would continue having unlimited gains in this direction. But because we sold the 105, we seal this off.
Yeah.
Now, there's trade-offs here, right? We always have to say, what are the trade-offs? So if we were to look at the 100 call for 10, there's our hockey stick in red, or bend at 100. But you can see that our maximum loss down here is at 10. So when we did the vertical spread, what happened? We made that -3 because we collected.
If it goes the wrong way, right?
We collected 7. Right. So you are reducing cost, but what's the cost? What's another opportunity cost over here? Are all of the gains. You are giving those up. But a lot of times that's going to be a good trade-off. Look at how much sooner we hit our maximum gain. We just talked about that recently. We hit the gains much sooner. We can also afford more spreads for the same dollar. We can get more deltas in here and really increase.
Right. So you get to make more money in the interim and give up the upside tail, and maybe that works for you.
That might be the better decision. But now it's also, we usually say that the debit spread is to reduce the cost or to make it cheap. All right. So we would say that this is the cheap strategy. But we always say that calls are puts, puts are calls, debits are credits, credits are debits. Couldn't we also say that we're reducing the risk here? Some people say, well, I've got $10 at risk. Now I've only got 3. So again, it becomes very difficult to say exactly what it is you're hedging. Now, you and I know that the better definition of risk is about probability. And unfortunately, a lot of people look at the dollars as the risk. And what gets people in trouble there is they'll say, well, if the stock is 100, I could buy the 120 call for 10 cents, and that's really low risk because I've only got 10 cents into it. No, it's very high risk. That's why the price is down. So you need to realize that it's not necessarily about reducing the risk. It's about reducing the cost. That's the main thing, the main philosophy behind a debit spread.
And here's a great example of that. We were just talking about this last night.
Yeah, we were.
At D-Dog trade, right? We had a UOA trade that came through where the
massive.
Yes, bought the stock was 140 and the
180s.
Trade bought the trader bought the 180s, and our man Justin in 3 at 3, he
brought
went
him down to the 160s.
Right. I mean, he paid more money, but he had a better probability of winning with the
Much
higher.
higher.
Yeah, that was a nice trade. So nice job.
Yep. So those are all things that have to be accounted for when you're placing your trades. But the main thing here is to recognize the big philosophy for doing a debit spread is you're trying to reduce the cost. Either A, you don't have the cash for it, or you just don't want to pay it, or you do have the cash for it, but you're going, man, $10 is at 70% vol. That's just not a good trade, but I'd still like to participate. Well, you might have to spread it off, and you're doing it to reduce the cost. All right, let's continue on. Before we do, please remember marketrebellion.com/get started. More stuff just like this. Great content, articles, and videos to help you with your options journey.
And
So let's
don't
talk
forget,
about the credit spread.
and when you're reducing that cost, don't everyone, don't forget that when you're reducing that cost, you are also reducing all your grease, right?
Oh, for sure.
The whole
Everything
trade
changes.
is just becoming smaller, right?
Yep.
You're reducing your delta and your
It's not for free.
gamma, all that is coming down. And you're giving something up, and it's a trade-off, like Bill
Yes, it
says.
is.
It's always a trade-off. You got to think of the big picture.
Right. They're always tools. It's not good or bad. It's just different. So to really become a great options trader, you have to say, what am I trying to do? And what's the most efficient way for me to accomplish this? Not, oh, I heard about some cool strategy called a short iron condor, and therefore I want to trade it. You don't trade it because of the name. You trade it because it's helping you solve a problem.
Oh, show me how to win like 90% of the time.
Yeah, all that kind of stuff. Right.
Show you how to win 100% of the time, right? Go buy a T-bill. So look, again, just to reiterate a little bit, you got to try to understand what's behind all this, and then it just will make sense. It just does.
Let's do the kind of the reverse process here for the credit spread. Let's say that you could buy a $100 put. It's trading for $8. Mm-hmm. And again, for whatever reason, you just don't want to spend 8. So you look on your board and you could sell the 105 put, and it's trading for 10. You're going, hey, wait a minute, that's even more money than this put over here. I could sell that 105 and I can get a net credit of 2. So now somebody has paid me to own the put. No, they have not. That's an illusion. That's what a lot of people think about the credit spreads. I bought a put and somebody paid me to buy it. All right, what's wrong here? Everybody out there in YouTube land, I want you to think what we talked about with our pricing principle. What are we looking at here? What's the controlling strike? Lower strike calls are worth more money and higher strike puts. So which of these is the higher strike? 105. And what do we know? Higher strike put must be worth more money, and it is, but it's also the controlling strike. You are selling the controlling strike. So here, if you are selling a put, what's your outlook? Just by itself.
Bullish.
That's bullish. So I know that's a bullish trade. I don't have to say, well, if I sell the 105 and buy the 100, all I have to do is say, what's the controlling strike? What are you doing with it? And
what do you mean? I'm trading puts. Isn't that bearish?
Might be. If you're buying it, they have negative deltas, but if you are on the sell side, you're flipping those. Now they're positive deltas.
Yeah, you're long delta.
Yep. So the purchase of the $100 put in this case is to reduce the risk. So now I can tell that this has the same risk graph in terms of just the overall shape. It's a 100, 105, and I can also tell it's bullish. But I went about it a little different way. I'm now selling the put spread.
See, and now you should be asking yourself, well, see how Bill says in that last bullet, purchase of 100 is to reduce the risk. He has reduced the risk in red. You should be asking yourself, what's the risk of selling the put?
Yeah, let's talk about that.
See,
you're selling that. You're on the hook all the way down to 0.
Remember we said you have a liability? Well, you do have a liability. Well, what is the liability? You just got to keep the conversation going with yourself. What is the liability? The liability is that I am obligated to buy $105 stock. That's the strike price.
That's right.
Right. No matter where the stock is, I have that obligation to, the term is deliver 105 shares at the purchase price of 105, and which you're getting paid for it. You're getting paid for it.
Right. But it's an obligation, and we can see that you are having to buy at 105 and you have the right to sell at 100. How much is that? How much are you going to make off that deal, Stu, if you sell it at 105 and buy it 100? -5. It's a losing deal. So why would somebody do it? Now we're seeing the credit.
You're getting paid.
It's not a credit because somebody's paying you to buy the put. It's a credit because you're holding a liability.
Yeah.
You're holding a $5 liability. And as Stu said earlier, nobody's going to pay you $5 for that. So it's going to get discounted. Right now they're willing to pay you $2. So you're collecting $2 in the pocket in exchange for maybe having to pay out $5. It's like acting like an insurance company. You're taking in a relatively small premium. You might have a big payout later. But you are not going to make money from the spread. That's only a liability. You could make money from time decay, but you're not making money from the spread. Spread can only cost you money. So because this is a liability, anytime we sell an option by itself, a naked option, this is the chicken strategy. All right, so let's go look at our risk graph. Look at that. Looks an awful lot like what we just saw. So here's our $2 credit. So now Stu, run it in reverse for us. If we have to buy at 105 and we can sell at 100, how much is that?
Let me see. Where's my calculator? $5.
$5 loss, but we got paid $2. So what's the net?
$3.
$3. Well, that looks an awful lot like the thing we just looked at.
So, look, for a couple of our people that have been with us for a little bit of time, Dr. Joe and my friend Dan, Damon, all you guys hopefully have recognized that, earlier on, a little bit earlier, a couple minutes ago, that there was a method to Bill's madness here, that the $3 debit spread is the synthetic version of the $2 credit spread on the
same thing.
It's the exact same risk graph.
Right. So are you getting something beneficial because you got a credit or because you got paid for the spread? Why can't I say I paid $3? See, if I said, hey, Stu, I bought this spread for $3, and Stu said he sold the spread for $2, some people would say Stu did the better trade. We are in exactly the same risk graph. Exactly. They're just two different ways of saying the same thing. So notice if we sell the 105 put by itself, that's what that would look like. Now we can see it would head forever, at least down to a stock price of 0. That's a liability. That's a huge risk. And we're thinking, as much as I'd love to sell that 105 put, looking fat and juicy up here at this 70% vol, 70% vol can also go against you quite quickly. I'm not wild about having this unlimited downside.
If the stock's 150, I could sell the 100 put and get
right. It'll never the stock will never fall there.
It won't go down. Really? 50?
How many stocks fell 30% on Monday?
A bunch.
A bunch. I mean, we had tons of them. Lots of, yes, it can fall there because if it had literally no chance of doing it, nobody'd be paying you for it.
Right.
And if they're going to give you 50 cents for it because it's so far out of the money, that should be a clue. It's not as unlikely as you're thinking. So we're looking at this going, okay, yes, in a perfect world, I'd love to sell this 105 put. I'm just not so wild about this unlimited downside. So what could I do? Let me buy an insurance policy. I'm afraid. I'm chicken. So that would be my motivation for buying the 100 put. And now if we compare this, there's our naked 105 put compared to the short 100-105 spread. So if we sold the put by itself, yes, we could pocket the full 10. But we also have this unlimited tail down here. So to reduce this risk, what we have to do is we have to do what? We have to give up some gains. And that's your trade-off. So this is the chicken strategy. I'm primarily doing it to reduce risk. Who wants to reduce gains? Right? We're not doing this because we're going, I'd rather just give up some of my gains. We're doing it to reduce the risk.
I'm all about reducing gains if I can reduce my risk exposure.
Of course. That's the point.
I'm happy to do that. I'm not
that's right. Right. No.
Worried about making the money part, right?
Understood. I was just saying in a perfect world, in a bubble, all things equal, you're going, why would I want to give up my gains?
Yeah.
I'm just saying that's the motivation. You're saying, well, I would do better off by selling the naked put. That's true. But the reason we're giving up some of the gains is to reduce the risk.
Absolutely. Right.
That's why we're doing it. And so that's will help you to understand that any credit spread, call or put, think of it as a chicken strategy.
And that's what risk management is, right?
Yeah.
That's the essence of risk management. Am I willing to give up some, part of that $10 there? Or am I willing to give up some of the gains from that $10 in return for a reduction of the entire trade?
Right.
Which would benefit me if it goes the wrong way. See,
Right.
people don't like to think about that. Oh, I think it's going my way, so I'll just.
We all do, of course. That's the reason we're getting into it.
Right. That's the reason why we're getting into it. And there's a lot of psychology behind that too. It's like kind of why we get so disappointed when it doesn't, because our expectations have failed, right? So, we feel responsible in some way. But that's what risk management is about. Like recognizing that there is a possibility that it can really go the wrong way. And if it does, what's it going to look like? And we have
Absolutely.
to temper those dollars to an acceptable level, before it happens, right? After it happens, it's too late. So, when you're asking yourself, how can I get my money back? Or how about this one, Bill? You're going to love this, right? Ready, sitting down. Can I repair this trade?
Oh, yeah.
It's just ridiculous. You can put a new trade on, and there are
Put a new trade on. The old one's done. That's a sunk cost. That's gone.
Sunk cost, right? You can do something new, and you might be able to help yourself out in the future. But it's gone. It's gone. So
yeah. So let's look at this one a little bit more in detail. We could pocket the full 10. How much of the gains are we giving up? What's our max gain on the blue one here on the spread? Was 2. So what you could do as a trader say, am I willing to give up $8 in exchange for knocking out how much risk theoretically do we have here? $105 worth. That's really the question. Not, I don't want to sacrifice my gains, or I'm getting paid for it. You're getting paid to accept a liability. So don't worry about the word credit. The reason you do a credit spread is because you're fearful you're chicken. All right, so that's kind of a way to understand the philosophy of any credit spread. And I think, do we have, I thought I had, I think that was from another one in here that I was, I guess we could probably do a similar thing here, but even with a condor, right, which are really just 2 vertical spreads.
Yeah.
We could, if we buy the 100, 105, you could sell the 110, 115 call spread. That's a short spread right there.
Long spread, short spread.
That's long spread, short spread. Might get a net debit of, let's say, 2. What's happening here? We're buying a call spread, and now we're spreading a spread. We're selling a spread against a spread.
Yeah, you're hedging your spread.
You're hedging the spread. Now we got a max gain of 3. Now this is my risk graph. Max loss of 2, max gain of 3. All right, so those are some of those would be our break evens right here. We know that this is going to be $2. We have to make up on this side, right? And we have to do what? I'm sorry, here's our short call up here. Okay, so we know that that's going to be 113. I can either say it's 115 minus 2, or it's 110 plus 3. I have to make up, or I can allow $3 worth of slippage over here. So 2 different ways of coming up with the same answer. It's just a vertical spread. All right, so you can do the same thing with butterflies, iron butterflies, short irons. They're all the same because they're made up of vertical spreads. Yeah. And so once you understand those basic principles, I think it will go a long way into learning lots of strategies for just a few pieces of information. So let's do a quick review here. Debit spread. You are reducing gains to reduce the cost. And that is the cheap philosophy. And with a credit spread, what are we doing? We are reducing gains in order to reduce the risk. And so that's the chicken strategy. Notice that in both cases, you are reducing something. And the question is, what are you reducing and why? Use that before you step into any vertical spread and you'll make better decisions. So let's answer our chalk talk here, Stu. Is a debit spread reducing risk or cost?
Well, you know me, man. I'm going to say, yeah. Cost, we'll go with cost. Or
I think that would be my primary one. But again, some people would say if you're reducing the cost, you're also reducing the amount you can lose and reducing the risk. I'm just not wild about using dollars
yeah,
as
me,
a supplement for the word risk.
same. You know,
But
I look at that and say, if I'm reducing my cost, I must be reducing something else. What else am I reducing? And that's
yeah,
how I look at it,
that's
right?
more of what we're trying to get at. That's the way that you have to approach this, not I'm becoming less risky because I've reduced the cost. Because you could do that by doing a super far out of the money option or far out of the money spread
Yeah.
and make it even cheaper.
Like
And you
that's
shouldn't say
money.
that you've reduced the risk. It's still a super risky position. It's always about a debit spread is to reduce the cost. So just for fun here, what about the credit spread? What are we reducing there?
If you do the debit spread, we are reducing
No, the
the
debit spread we just answered, reducing the cost. The credit spread is
risk.
you're reducing the risk. All right. So if you ever get stuck on that and trying to figure it out, always remember your pricing principle. Lower strike calls, higher strike puts must be worth more money. And you can figure out the rest. And then just remember cheap or chicken. And that will help you with your vertical spreads and hedging some of the volatile markets that we've already seen, even though we're just still not even out of the first month of the year.
Mm.
Any closing comments there, Stu?
Think it through, everyone. Just think it through. It's not terribly difficult. Stop, don't
Right.
think you got to memorize everything. Just
Don't
start
memorize
with
it.
the basics, the intrinsic, the extrinsic, what will happen down the road as the stocks move around and time goes by and files go up and down.
Right.
Just think it through in a logical fashion. Most likely, you're going to come up with pretty good answers, right?
Yeah.
Pretty
And
good.
that's another thing we always teach people on our Q&As. I know you and I have talked about this a lot where we don't memorize formulas.
Yeah.
So like if somebody said, what's the maximum gain for a vertical spread? Look it up on your broker's platform. They'll have a definition. I don't know what the definition is, but I can think of it really quickly. A debit spread is going to be the difference in strikes
Minus your
minus the
cost.
debit. What's the maximum gain for a credit spread? Well, think it through. Maximum gain would be the credit. Max loss would be the credit minus the difference in strikes. Debit spread, the maximum loss is going to be the debit. So without having to memorize formulas, all I have to do is just think about those pricing boundaries and I can figure out what the answers are. And that's going to make it a whole lot easier rather than trying to memorize every twist and turn in the options market. So if you're trying to take your options trading to a higher level, please check us out, marketrebellion.com. You can get hooked up with Stu to do some private one-on-one coaching, or Scotty. We got to get Scotty on here maybe next week.
You do.
See if he's free. But with that, stay hedged, and hopefully we're going to continue with a nice little rally for the rest of the week, and we'll see it either come true or not, but we'll revisit that next Thursday. We'll see you at 4 p.m. on Coach's Corner.
Yeah.